The Federal Reserve and other central banks have printed trillions of dollars over the last few years. The question is, what happens when they turn off the tap? You came here for the truth, so let me unveil that for you. This is the big question. We have seen quantitative easing from different central banks around the world. They have printed $15 trillion since the financial crisis ended, and we have this curious question. What is it that could sustain the market as long as QT, quantitative tightening, is taking place? So let's get into it today. Central bank balance sheets, you can see on the left-hand side right here, assets since the end of 2007. So since that financial crisis time frame, you can see clearly that they have increased their purchases. Their balance sheets have grown to enormous levels. But if you look very carefully, we are just starting, just at the little tip. I don't want to draw over it so you can see it has begun to decline. Now, it's a fraction, but this is the beginning. In no time at all, this will cause a very, very big problem for the global markets. Now, this happens to be looking at the Swiss National Bank, Bank of England, the Fed, ECB, and the BOJ, but understand that all central banks love to print money. They love to make sure that their interest rates are low so the money is cheap, and that they only know one thing, and that is to engage in their policies to enrich the banking establishment, the financial system. And they do so at the expense of the average individual. Every dollar they print into the system devalues the remainder. That's why it is very dangerous to hold on to cash as a means of savings. You can ask the people of Turkey, you can ask the people of Argentina, even in Brazil as well, and let's not even get started on Venezuela. This is what central banks do. So that's the facts. Now we're going to get into some more details here. Policy liquidity flow, 6-month rolling, as a percentage of the GDP, and they are decreasing. Whether we're looking here at the US, China, and so on, we have to understand that on average, the central banks are pumping out less liquidity than they were a few years ago. Some of them have stopped printing, some of them have tightened, some of them are still increasing, but in general, there is less money flowing into the system. When you look at different central banks around the world, on their total levels, that is measured here. Now, what they're doing behind the scenes, we don't know. We found out that the Federal Reserve printed $16 trillion. That was not accounted for in the $4 trillion that they have on their balance sheet. And who knows what else? How much else was printed? We don't have those facts. All we know is that they printed at least $20 trillion. That money went all over the world. What has happened since? We don't even know. We don't know if they ever gave it back. Probably not. And it was free money. And here we are today. Right? That is a fact that was released. We know that. They were confronted about it. Nobody got in trouble. Nothing was done afterwards. We just found out the information. That's it. It was in the news for about 5 minutes, and I've been mentioning it ever since, but the average person doesn't really care. Shifting gears, number of emerging market central banks hiking policy rates less those cutting measured end of month. What I'm trying to show you right here is that now they are tightening up on their policies. All right. So it gives you the list of central banks at the bottom. It's a long list. In fact, they're starting to try and tighten a little bit. This is just the beginning, but you can see that this will have a dramatic impact. And I want to make sure to mention something by the end of this video. So hang in there. While markets reached dizzying heights during the easy money era, that flood will dry up by the end of the year. For the first time since 2011, central banks are expected to suck out more cash in 2019 than they pump in. Imagine that. Suddenly, everything is going to change, and it's going to happen before people know what hit them. They're never going to be able to predict it because they never do. Nobody ever does. That's the silliness of typical investors, where they'll think to themselves, okay, as soon as the stocks start to come down, then I'm going to sell. Yeah, I'm going to wait. Okay, I'm going to wait until the right time, then I'm going to sell. That's the mentality. I've heard these statements before. Fools. The ECB will stop additional bond buying at the end of this year, and while the Fed has been shrinking its balance sheet for almost a year, it will step up the pace from October, removing $50 billion a month from markets. Bonds worth $470 billion will roll off its balance sheet next year. It's going to be slow. It's going to take a lot of time. I don't know how far they're going to be able to take it, especially with rising interest rates, but it definitely is going to be a fun time watching it. That's for sure. All right, so moving on right now. Looking into this, we're seeing the emerging market currency index, and that has been doing terribly. The emerging markets, stock markets as well, they have been doing just as terrible as their currencies. Weakness all around. You can see that there are different, I have a little bit more to show you here, but many of them have been declining, and it's actually having an impact on that particular economy in that country. EU banks are down. You can see it. We're still hovering around minus 21% now. That causes major disruptions, okay? When you have the banks in a bear market, you have to start wondering, who are they going to lay off? What are they going to do? Are they going to start bringing in new technologies like robo-advisors and completely eliminating the jobs this time around? That's probably what some will do. They won't need as many people. They can replace tellers at the banks with iPads. They've done that before, and there's different ways to streamline things, have more people do online banking, and so on. So when we wipe out the jobs, they may not necessarily come back this time around. In the previous instance, I don't know if it was just Europe, but I have it in my book, and now I can't remember exactly. It was either just Europe or global, but we had 200,000 jobs in the financial industry that were wiped out because of the financial crisis. Unbelievable. Global, systemically important banks, the GSIBs, you could see that we are down now to levels back in 2017. These have really crashed. They were taken off, doing so well up until January. The VIX issue happened. This came tumbling down, and here we are today in an official bear market. And this is the actual too big to fail banks. It's very worrisome, but hey, nobody really seems to care. These are the percentage change from 52-week high. You're looking at things like gold, you're looking at oil, you're looking at different currencies. I'm noticing copper in here. There's all kinds of things, and there's a large amount of different markets and everything that are really doing terribly in this year 2018. And it's not just one or two, it's the vast majority of investments today are not doing well through 2018. I mean, if you look at the growth since 2009, obviously, yes, they've done well. But in 2018, we are definitely off the peak. Now, a lot of people will say this stock market's going up. I hear that all the time. There's one stock market going up. We don't see that going further in. I mean, dig a little deeper. It's not all about the NASDAQ, not all about the S&P 500. And this right here shows us JCPenney. Just wanted to show you one more major store. That stock is basically worthless at this point. We know where it's headed. This is the same as all these other big box stores and everything that have been closing their doors. Truly unfortunate, because a lot of people have lost their jobs as a result. Now, I want to talk about what's happening here with the quantitative easing, with the interest rates, and with the central banks and their policies. It's very clear to me that these central banks have been around for a very long time. Okay, so we have a history of these banks and what they have done through previous crises. And the same thing occurs over and over and over again. Whether we want to look at this from the financial crisis, maybe the dot-com boom and bust, and so on, the Federal Reserve, as an example, was there. They were present, they were available, and they were paying attention to what was happening in the markets, yet it quote unquote caught them by surprise, and so we had a crash. This happens every single time. There is a drying up of liquidity that occurs every single time throughout all of these different crises. Every time, 100% of the time. And they bring the interest rates up. They slow down on their money printing. Maybe you have more lending restrictions coming into place. Maybe you try some desperate attempts, one thing or another. But ultimately, it ends in a market crash. The market crash can come from anywhere. We could have it from the subprime mortgages. It can be something that happens in Latin America. We have the Asian crisis. We have the, different countries that start to engage in hyperinflation. And these things can have a domino effect and a greater impact on their trading partners, as well as that ripple effect into the rest of the world. No country is immune. And if you wonder why would they do that if they own all these assets, remember, they own the establishment. They own the central banks. They own all the major corporations. Whether that price gets down near zero, or let's say it decreases by 50, 70, 80%, it doesn't matter. They're holding those stocks, those investments, the real estate, all these big things that they have, land and everything. They're going to hold off, and they know where to put their money to make sure that it's going to be worth something one day. But they also have the insight to realize if stocks come down by 50, 60, 70, 80%, I'm going to be able to just throw more money in. It's okay because I can withstand, even if, that amount of money is decreasing for this period of time, maybe the next couple of years, 10 years, even 15 years even. I've got a whole bunch of cash just sitting here. I'm going to put it in there. It's going to be worth more one day. They have an unlimited amount of money. They can do whatever they want for the longest period of time. It's not going to affect them. You have to remember that. All their mansions and estates and everything are all paid for. So it's not the same as you and I, how we have to worry about, our income next week or next year. They're not doing that. They're planning, going for the long haul here, 100 years and beyond. That's the way they're thinking. So it's you have to just look into it a little deeper for those who just, quite frankly, don't want to believe it. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps us support this channel. I do appreciate that very much. And if you want to check out my books, there are links in the description you can check out, bring you over there. Take care.